All right, so cool little fact about the market in these giant manipulating wicks, right? Whenever you see like a massive wick like this that happens earlier, and then the market kind of corrects and goes to the upside, just know that we're usually not going to reach a new high until we fill this wick with the body of a candle. So notice that the wick was right. Let me enlarge this. The wick was right here. It happened at like 8:30. Just randomly wick down. And we'll put a white line right there so you can see it. So the body of a candle has to fill this wick now. This becomes a volume. This becomes an imbalanced play. So we start to go up, can't reach the high, can't get back to this blue line. We're like, okay, cool. And then we slowly start trending down until we fill that candle wick with the body of a candle. And you'll see it. It happens all the time over here too. Wick to the upside and the downside right here. We fill it with the body of a candle. We create a new wick right there, just like this one over here. Market goes up, create a wick right there. Market comes down, create a wick there. Fills this wick with the body of a candle here. A little bit right there. You get a wick, fills that wick as we're going up. We get a gap up right here. We're eventually going to have to fill this gap. And then look at what happens. The market goes all the way up here. Leave that wick behind from on Tuesday. We're eventually going to have to fill that. And we're getting a preview a lot of times with this of where the market's going to go to next. Market goes up again. Can't push up there. Has to fill that wick. Has to fill this gap. Notice that we filled this gap exactly. And now that leaves us with the opportunity to start heading north again. And we are $2 higher today than we were last night yesterday when the market closed. But all of these volume imbalances have to be filled in the market. So at some point in time when these gaps happen, it can either be going up or it can be going down. They have to be filled. They cannot just be left behind. So it's kind of like a promise to return one day. And a lot of times when we see the market falling, we're like, oh, the market's crashing or whatever. No, it's correcting. It has to correct all of these holes that it has that are left behind, all of these massive gaps that we have in here that we've had for, like a week or two. And now we finally corrected to this level. So you could use this when the market's falling and falling and falling. You're like, where's it going to stop? Go on your 4-hour time frame and look back at days like this and be like, okay, cool. This is probably an area where it's going to stop. And most of the time, it's absolutely going to. But now we're pushing back to the 587 area, getting ourselves going north. But like I was saying, when you create a giant wick like this, and this is only on the 5-minute time frame here. This is 4 hours over here. This is a daily, actually. This is a 5-minute time frame. It happens even on the 5-minute time frame. You'll get a little warning through the manipulation as to where it's going. Then the market will kind of return and go back up. And the reason, see, the first one is right here. They were correcting those wicks. The reason is that whenever there's a quick imbalance like that happens, it's just a preview as to what's going to happen over the next hour or two. So we push back up to the 9 EMA and the 23 EMA. The 23 EMA is this yellow line right here, and the 9 EMA. If we would have crossed and went all the way up to the blue line, then they would have been like, forget about that wick. We'll come back to it later. But because we never passed the 9 EMA and the 23 EMA, we stayed below it. We trend it down, we trend it down, we trend it down, we trend it down. We get dead even with it, which is cool. It happens all the time. You'll see. And then we start going up and up and up. And look at the 9 EMA and the 23 EMA. 9 EMA being the green line, the 23 EMA being this yellow line. Once we finally break it, then we start an uptrend and we start to ride above it. And I don't trade trend lines, but I do use them to confirm the trend that the market is going in. So now we're turning this way again. They cross, they're going down, we're below it. Turn again, they cross, they're going up, they stay above it. Now we've been staying above the 9 EMA the entire time. We're about to touch the 23 EMA right now, but what's going to happen is the market, this red line right here, the 200 EMA, is acting like a magnet. So it's pulling the market up, pulling the market up, pulling the market up. And then once we touch it, it can reject a little bit and push back down. And then this blue line here is a point of interest off of the 4-hour time frame that the market's trying to get to. But we had a beautiful fall. In days when the market falls, I know a lot of investors are panicking and stuff like that, but days when the market falls like this, you can make so much money fairly easily. And one of the most beautiful trade scenarios, right, is this right here. We're coming down to a demand zone. We bounce off the demand zone. We pull back up to equal with the previous candle. We can't go any higher. And it's a warning sign like beep, 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 beep. Hey, we're going down further. And if you just get equal with this candle right here, I don't care how many contracts you put in, but let's just say you sold one, and then you're protected to the blue line. The blue line is $275. I always go above it, so I'm going to go to about $300, $312, whatever. It doesn't matter. It's going to be $300, but it's hard to get like perfectly on the line. And then your take profit going below the line to the bottom of the demand zone, easy $800. You know, if you're trying to get to the next blue line, because it, like, let's say it doesn't stop in the demand zone, then you just move your take profit to the next blue line. Easy $1,200, one contract. Now, if you're trading ES, oh, this is ES, perfect. This is ES. This is not even NQ, but the same thing's gonna happen on NQ. Watch. So what time was this? This was 2:15 in the afternoon, right? 2:15 in the afternoon. Now over here on NQ, here's 2:15 in the afternoon. The exact same thing happens, but it happens even cleaner because you don't have the wick up like you did to the 90 MA on ES. So now you're getting in right here, in between this candle. As soon as it meets the body of the candle, not the candle wick. When it meets the body of the candle is where I get in. So like I'll sit my trade right above this blue line here, right? So, and that blue line is 50% of my supply zone. And then let's say I set 300, or let's do $500. That's a safe spot for NQ, and that puts me just inside that volume imbalance. And if it goes into the volume imbalance right there and pushes up to the yellow line, which is the 23 MA, then I know that I'm just wrong with the trade, and I'll let the trade go. And then you take your take profit right at the bottom of the demand zone, $1,900. But if you see that it's approaching your take profit, right, and like fairly cleanly, like this doesn't pull back a lot, quickly take your take profit, put it to the next line, which is the blue line. The blue line would have got you $3,800. So if it's approaching the blue line pretty cleanly and it hasn't come back to the 90 MA and we're about halfway down, take it, put it at the next blue line. The next blue line is $5,900. It's two contracts. I'm sorry, let me adjust this to one. I'm like, that seems like a lot for one contract. Boop. One contract. There we go. So now you're risking the exact same amount that you were over on ES, right? With one contract. I was thinking that it seemed a little weird that I had that 500 because the risk is usually the same, but the amount that you can make with NQ is higher. So now it makes a lot more sense. So we get in at the body of the candle right there. It wicks up a little bit. You go about negative like $10, and then it starts to pour down, pour down, pour down. Why? You get the warning because of this candle wick right here. You hit that. So now let's go back. That's $1,000. Either way, you had 800 before. You get $1,000. You get like another. It's like 1 to 1.2 for ES and SPY. You get down here. You now have $2,000. And then what's beautiful about 2 o'clock in the afternoon is you now know that this is just, it's not stopping. So you just keep going to the next line. Every time you approach about halfway down, you go to the next line. Doesn't pull back, cool, $3,000. Go to the next line, $3,700. Now here, it's going to start to pull back, right? But the whole time that you're trading and that you're moving forward and you're going to the next level, what I want you doing is taking your stop loss, move it to the previous level. So now your stop loss would be sitting, you want it above this volume imbalance that it shows right here, in between the 200 EMA. So you're gonna be sitting at about $800, right? About right there, that white line. Then as you get halfway down here, and then you touch the blue line, you're gonna take it and you're gonna put it to volume imbalance again, right there, halfway through that. Then you're gonna go boop. And then this is gonna keep going down and down and down. And your trailing stop is going to keep, it's called trailing stop. Your stop loss here is going to keep following. So we get halfway through this area right here. Now you're going to bring your stop loss to this point. And me, I'm a lot more aggressive with my trailing. I trail immediately and I start locking profits immediately because I just don't have patience like that. But if you have patience then you're going to make a lot more money than even I do. I know people see me get in here, and that's why you'll see me use more contracts, because I'm trying to make the money faster, the same money that you're going to make if you have patience. And the reason that I'm making money faster is I'm a scalper. I'm not trying to intraday hold. This hold, I would make it to from 2 o'clock in the afternoon right here to 2:30, but I'm not going to make it past 2:30. I just don't have the patience. So at 2:30, when we started to pull back right there, I would have instantly took this and be like, cool, 3K. Now, what you saw me do instead was put 10 contracts at the body of this candle right here and take it down to the pink line. And then that gave me the same, gave me 7K, because, you're doing 10 times the actual amount of contracts. Now, had I had amazing patience and the forethought to realize that we're going to the other demand zone once we cross that halfway point, then I would have been like, cool. And then we made it to this primary demand zone 0, the new demand zone that we created down here that we're working through. We wicked through it, came into it, and pushed through. So now there's another demand zone way down there that we almost reached, and that's what's pushing us back north. And then as we go to the right, we're trying to make it this like halfway through the demand zone. We're trying to make it up to the supply zone now, and then the top of the supply zone is where the 200 EMA is. But that's just like a quick tip for like getting a decent amount of money out of your trades, trailing it down. Now, what you really want at 2 o'clock in the afternoon, let me cancel this. What you really want at 2 o'clock in the afternoon is you want to be in the first part of the trade. Okay, so we have been consolidating. We were pushing up a little bit. We've been consolidating. There are 2 different types of consolidation. There's consolidation that ends in continuation, and then there's consolidation that ends in reversals. Consolidation that ends in reversals looks like this. We pulled back. We couldn't reach a line. We start pushing up. We get out of the demand zone. We push up to a resistance area. This double line of resistance is a strong level of resistance, just like right there, strong level of resistance. We hit the top of that, and we can't get through. Can't get through. If we're going to continue, one of these candles is going to break through. Then we get this cute little hammer candle right here. A little bit of hammer candle. And then that hammer candle is a preview of what's about to happen. So now this is at 1:35 in the afternoon. By 1:30, I'm already in the play to the downside. As we're hitting this line, I've already set my play up, and I'm just going to ride that to the downside. If we're not breaking this area, we're going to reverse, usually, right? You can tell the difference between consolidation is going to continue and consolidation when it's going to reverse. So 1:30, we start reversing 1:55. By 2 o'clock, by this 2 o'clock candle right here, I believe you should be in that trade. So entry A right here, entry B, 2 o'clock, entry C down here. I took entry A. I got out at entry B because of the pullback. The pullback's always going to wake me out. Then I watched, and then I got in at entry C and took more profit, but I did it with more contracts. And then I took entry D here off of the pullback, and you see me get in right here, and then I get it out at the blue line, which with more aggressive pushes, you're going to get quick cash or whatever, and then you're going to get out. So then it gets all the way through there, but I'm always going to get kicked out at these lines because there's going to be a little bit of a pullback once you touch a support area. It's going to push back up a little bit, and you see in the next candle where we get blue, it pushed back up through about halfway, and that's always going to get me out in particular because I'm trailing very tightly. But yeah, man, you guys have a great day. That's just another a cool little teaching video. I know I don't do too many of those. They're more so on the YouTube side of things, but I figured I'd do that for TikTok. You guys have a great night. Happy hunting out there. The goal is to get back into the supply zone, but we could always hit the bottom line right here of the supply zone and reject back down to the 50% point. But it's looking like we're gaining some decent steam. So we're going to go right back up to fill this gap, which will be at like 589.64. So for the longest time, 589.64 was acting as support. It was acting as support on the daily right here. It was acting as support right here. It was acting as support, but we had wicked through it a little bit right there. But as soon as we had hit 589.50, it sent us right back north. Yesterday we broke 589, so now 589.90 is going to be acting as like a resistance area, keeping us out of 590 and going back north. So we'll probably hit this 589.90 line and then push back down a little bit. But once we break that, it'll allow us to go back up into the 590s to the 600 mark. See right here, 600 was acting as a resistance. Before it was acting as support. It was acting as a resistance here. It was acting as a resistance here. It was acting as a resistance here. Support, support, but we went through. Support, it's acting as support. It's acting as support. It's acting as support. We finally break through. It starts acting as resistance. Once you break a strong level of support, which is a demand zone, or a strong level of resistance, which is a supply zone, it starts to force you back down every time you hit it. But again, you guys have a great day. This has been fun. This has been another Full Transparency Trading Session with your host, Sebastian, and I'm out.